Hi guys, welcome to the first video for the Maversify YouTube channel. The idea for this channel is really to just talk a little bit about finance, invest in what's happening in the markets from time to time, a bit about what I find interesting in the markets. So just an introduction to me, my name is Manu and I've been investing since I was 16 years old. So it's coming around to around 7 years now, in both frontier markets as well as developed markets. I did my bachelor's at UCL Economics and I'm currently doing my master's at London Business School. I have work experience in finance and technology across Asia, Europe, done my most recent work experience at a fintech firm in London, and I'll be working in finance in London. So I wanted to unpack the Gamestop saga for a lot of you. I know there's a lot of videos out there that sort of unpack this, what happened, what are the consequences, so I don't want to get into what happened with the stock so much, but I want to talk about lessons learned for average investors like you and I. What can we learn from what happened with GameStop? Initially what had happened was that hedge funds, very simply a pooled fund, so you have a lot of people that put money, usually sophisticated investors as they call it, that put money into the fund, and the fund goes ahead and does a whole bunch of strategies, invests in a whole bunch of assets and tries to deliver returns. These funds are not open to ordinary investors to invest in simply because of the risk attached to it. A lot of the strategies they use are quite sophisticated in nature. They use derivatives to hedge against their positions and things like that. What happened with GameStop? So essentially hedge funds thought that this stock was overvalued, that it was too pricey, so they took a short position, and there's a lot of videos on what that means, but very simply they bet against the stock. It's a very risky strategy. Your losses are unlimited essentially, and it's the opposite of this is the long. The long position is you buy a stock and you expect the price to rise, and that's sort of what most people do. You buy because you believe in a company, and so there's a lot of talk as to, oh, should shorting even be legal? You're betting against a stock. People invest in stocks, people invest in businesses because they believe in those businesses. I was talking to my uncle recently and he was asking me, why is this legal? Why is it allowed for a hedge fund to bet against the future of a stock? It's a way to keep markets efficient. If there are people buying stocks, there have to be people selling stocks. So if people bet in 4 stocks, there has to be someone on the other side always betting against the stock. And this back and forth, this discussion, the contrarian views in the markets, these are very important for markets to work efficiently. In some markets, it's not even allowed. So I grew up in Sri Lanka, and I know that at least when I was growing up, the short in stocks was not allowed in Sri Lanka. Even institutional investors, even the funds in Sri Lanka couldn't actually short stocks. Because of the risk attached with it, it usually only also exists in very liquid markets, very big developed markets. Shorting is quite a sophisticated form of investing. So when it came to GameStop, it was a heavily shorted stock. So a lot of funds like Melbourne Capital were sort of betting against the stock. And the idea that the people on Reddit had was that, if we all got together and we bought this stock, we could push the price up. And this would force the hedge funds to cover their positions, their short positions. So if you're a hedge fund and you're betting against a company, you borrowed that. Those shares from somebody, from the brokerage. And so if the price of the share rises, then the brokerage will get worried. It'll be like, how are you going to pay me back? To sort of cover their short position, the hedge funds will now need to buy stocks. What happens is that if the price actually rises when you expected it to fall in a short position, you would now need to give additional collateral to your broker. It's called a margin call. So the idea that these Reddit investors had was that, if we start pushing the prices up high enough, that the hedge funds will now have to buy these shares back and cover their positions, and that demand, so it's all demand and supply, that people are buying stocks, the price rises. Hedge funds like Melbourne Capital were facing bankruptcy, and this time retail investors did win. But this isn't a sustainable strategy. GameStop's price crashed, a lot of people lost a lot of money. It's sort of the perfect time now to reflect back. I wanted to speak a little bit about, we're a few days removed, what are the lessons learned from GameStop? What did we actually learn from this? Number one, investing in stocks is fine. It's a great way to grow your money. It's a great way to sort of take your money further, but there is a scientific process. There's a reason these industries have been around for so long. To make money in a stock, it's sort of, there's a lot of people speaking about this topic right now, but Warren Buffett has always said to sort of think of it like you're buying a business. You're not buying a stock, you're buying a business. And do you believe in that business? If you were going to buy a business, you would, look at who runs the business, the governance, who's the founder, who's the CEO. What do you think of that strategy, their vision for the company? Look at the cash flows. Is the company actually generating money? Common metrics like price to earnings ratio. So you're not just looking at the price, but you're looking at price as a ratio of its earnings. All these ratios are sort of online. You can just find them for any stock you want. And you can look at it relative to the industry. Oh, so the industry's price to earnings is 15, but this stock's price to earnings is 30. Oh, it's actually overvalued relative to its industry. So maybe what you see in the company has already been taken into account. There's a whole bunch of ratios. You look at earnings growth over the past 5 years. Has earnings been continuously growing, or is it very volatile? That's also important. Understanding the science behind investing, understanding these ratios, understanding how to look at the value of a company rather than just the price of a company. That's step one. This unfortunately isn't something that delivers returns over the next 2 weeks, 3 weeks. This is something that delivers returns over the next year, 2 years, 3 years. And the best investors know this. So they think of it like buying a business. If you bought a business, you don't expect it to bring money to you tomorrow or a week from now. You expect to invest in the long-term future of this company and you believe in it. Find stocks that are financially strong, which you think are undervalued, and you read about their business, you read about their governance structure, you read about what they're doing, and if you believe in it, invest in it. Learn more about how to value companies, how to assess the finances of these companies. Number 2, don't buy into the hype. A lot of hype nowadays with a lot of investment ideas. So if you look at something like Bitcoin, once you start seeing celebrities and media talk about investing in a certain thing, you probably already missed the wave. I remember when I first got into investing, I was investing in stocks. I would ask people, what have you invested in? What are your clients invested in? And I would ask brokers. If there's a very popular stock that everyone's invested in and it's suddenly everywhere and the media knows about it, everyone's talking about it, it's precisely the wrong time. Everyone's already put their money in, the price has already reached the top. Let's look at Bitcoin. So it's mathematically, it's easy for a stock to jump from 50 to 100. If stock jumps from 50 to 100, that's 100% increase. But for a stock to jump from 45,000, right now Bitcoins are at around 45,000. For Bitcoin to jump from 45,000 to 90,000, that same sort of 100% return, as you can see, it's a lot harder. It's easier to jump from a smaller base, 50 to 100, than 45,000, 90,000. So when you're at a high price, it's kind of the wrong time to buy. You can't expect to see those returns that early Bitcoin investors saw because the price is quite high right now. The value of Bitcoin purely depends on what people are willing to pay to buy Bitcoin. Bubbles are very natural parts of the investment cycle. And a lot of people argue that right now we're in a stock market bubble and valuations are stretched and we should expect things to come crashing down very soon. Also diversify well. Your whole portfolio should not be one stock. You should have at maximum, I think, a threshold for yourself. So 10%, for example, maximum on one single stock. It's always good to invest in a whole bunch of asset classes. Bonds generally go the other direction as stocks. So if you expect a stock market crash and you have some bonds, expect that the bond prices will rise and you would actually cover some of your losses. Learning a little bit about diversification. You can diversify by bringing assets together, or you can diversify by adding more and more stocks that are uncorrelated. So if you think that tech is going to crash, what goes the opposite direction? Generally defensive stocks that are, they don't have huge returns, but when the markets crash, these stocks are a little bit more stable, the defensive stocks. So think of things like healthcare. Regardless of what's happening in the economy, people are still going to need healthcare. Think of things like utilities. People still need water and things like that, regardless of whatever happens in the economy. And the last point I want to bring out is to think independently. You should always do your own research. You should take whatever you hear and read on the internet with a grain of salt. Actually nowadays, when literally anyone can talk about anything, it's important to sort of do your own research. Go through the company's financial reports, the annual reports, read through it. Before you do your investments, it's very important to understand the risks behind those investments and not take anything that you read online just as a given, because oftentimes it's not. So investing is fine, but make sure you apply a scientific process to invest in. Understand how to value a company, understand how to look at a company and look at its fundamentals rather than just the price. You don't care what price you actually jump in if you believe in the 10-year plan of the company. Don't buy into the hype. Number 2, hype around things like Bitcoin and certain stocks as well. And oftentimes if you see something on Reddit, when you start seeing it, it's already been capitalized on. There's already people who've jumped in, the price has already risen. It's very difficult to make returns when the price has actually risen. And always keep in mind that it's always harder to recover losses than to lose. So if you buy a stock at $100 and it crashes to $50, so it's a 50% decline, to get back to that $100 mark, you would actually need to double your money. You need 100% increase. To recover a 50% decline in a stock, you need 100% increase. So that should tell you that it's very difficult to recover losses. So if you buy at a high price, you're at risk of the stock price actually falling, and to recover that fall you need a big jump. Or of course you could just follow a much safer style of investing, which is to invest through ETFs. There are ETFs that broadly track the S&P 500 entire US stock market. You can just track it and you can move along with it, get average returns. You could track the FTSE, you could track clean energy stocks. The world of ETFs is growing and growing and growing. An ETF is a basket of stocks, like it's around 100 stocks for example, and so if one stock crashes in the basket, your whole basket won't crash. So that's the idea behind investing in ETFs. You invest in a broadly diversified set of stocks at once, and so you're not exposed to the idiosyncratic risk of one stock. So investing in ETFs is also a good way to jump into the markets. Number 3, think independently. Always do your own research. Have a look at the company's fundamentals, what's actually going on, what's really happening in the company, and assess for yourself whether this is a good investment or not, especially over the long term. If you were buying a business, would you just look at the price right now, or would you look at the founder, the financials, what their plans are, their governance structure? You're doing deep research. So thanks so much for watching, guys. I have a website, diversify.com. I'll put the link in the description, where I sort of write about various investment topics and what's going on with the markets. Most recently, we wrote an article on the different hedge funds that did well this year and what they did. So if you're interested in that, please click the description below. It's going to go up here for now, just a link where you can just go and have a look at the website, read through some of the research. Don't take any of it as investment advice. It's not. It's just educational content that you can read and understand a little bit more about the markets and how to make informed decisions. And also hit the subscribe button below and like the video. If you enjoyed the content, it'll really help me, and this is my first video, so a little bit of support in that form would really encourage me to sort of keep on going. If you want me to talk about future topics as well, I'll be very happy to just drop a comment below, and I would be happy to sort of take that on and do a bit of my own research and come to you with a video as soon as possible. I hope you enjoyed the video, guys, and drop a comment below. What else can I talk about? Alright guys, for now, I'll talk to you very soon. See you in a bit.